Hello. Hello. Diana, Wendy, can you hear me? Miriam?
Yes, I can hear you.
Good. So we have Diana, Miriam, Wendy, Grace, Mengezi, Tera, Machado. So we will start now. We have about 1, 2, 3, 4, 5 students so far. So I will not continue waiting. Let me upload the screen. Let me share the screen. Are you able to see my screen?
Yes.
Yes.
Good. Good. So now I wanted to do a class on Zoom because of my restrictions to move around. So I was not able to attend a physical class today. But because we have very little time remaining before you go for your end of semester, I thought we should meet on Zoom. Probably we can arrange another Zoom class before, God willing, we meet physically next Saturday. So in the meantime, to cover more ground, after this one, I'll ask if we can meet again on Zoom. If you can't hear me, please let me know. Raise your hand and I'm willing to take your concerns. If I'm not speaking up, also let me know if I'm too low. So far, everybody is able to hear what I'm saying, right?
Yes.
Good. Thank you. Well, the rest of the class, you are men in your class. Are your colleagues there at the campus or where are they? There are very few people who have joined the class.
Some at their places.
Sorry?
Some at their places.
You mean at home?
Yeah.
So they can't join the class? I thought I sent the message very early.
They will join. They will join soon.
Okay. Please alert them that the class has started. Now, as an introduction, you remember that at the beginning of this course, we said managerial economics is about using economic concepts to make decisions in a business. And most business managers may not actually know that they are applying economic concepts as they make decisions. Now, in a business, there are two components. One component is the internal decisions, things that the manager has got a power to control. So, for example, controllable costs. Those are within the manager's ability, and the manager can be assessed based on his ability to minimize costs, for example, in order to maximize profit. Now, there are other costs which are uncontrollable, which means they are not within the manager's powers. Now, for those which are controllable within the manager's powers are to do with the business itself, the industry where that person is, or the sector where that person is, and looking at the issues of production functions and production cost functions and all those things that we have learned so far. What we have been learning so far are issues that the manager can control. And those are microeconomic issues. Microeconomic issues. These deal with the decision-making tools that are available to the manager, and the manager can control them. Then there are, and you remember, before I depart from there, you remember your first assignment, the microeconomic issues that affect businesses. Now, there are other aspects that affect a business where the manager has got no control, and these mainly are the macroeconomic issues, issues that are dealt with at a national level. And these issues include economic growth factors, include issues of cost of capital, for example, the interest rates at banks, sometimes even government regulations on wages. They include issues such as unemployment issues, which are related to economic growth, issues of exchange rates, and many others, which are in the powers of, for example, the central bank or the government. So these macroeconomic issues are the subject of what we are discussing going forward. Now, one issue that I've already mentioned is the issue of economic growth, issues of output. Now, if you remember very well, at a micro level, we are dealing with production functions. We are dealing with what a business produces. So, for example, if you remember the market, which I've been drawing in the previous lectures, where we have this diagram which depicts demand curve and supply curve for a business. Now, remember, for the whole country, we are talking of adding up all the businesses. For example, all the cement manufacturers, we will find the production of cement for Malawi. We can add up all the farmers who are producing maize, all of them. Then we'll be able to say how much Malawi has produced in terms of maize. We can do this for each and every product. Now, remember, in the perfect market that we have been studying before, you have this demand and supply of various businesses. Remember, on the supply curve also represented sometime, if you remember, we said the supply curve represents manufacturers, represents producers, sellers, suppliers. Now, if you add all of us who are suppliers, for example, if we say all of us are producing maize, for example, we will be able to see what the aggregate supply is. So what is the total supply? Aggregate means adding up. Aggregate supply of cement, aggregate supply of maize in Malawi, which basically refers to producers. How much have we produced in a year? The same thing we can talk about the demand curve. You remember the demand curve represents what you and me demand. For example, if we are saying how much soap do people buy? Bathing soap. So at your needs, my needs, and everybody else needs at the end of the year, we will have how much soap we buy. So we'll have an aggregate demand. And remember, the aggregate, this aggregate demand, this curve, we also indicated that it represents buyers, it represents customers, it represents what did we say? Buyers, demanders, customers, all that. Now, when these two are put in the same diagram, the supply curve and the demand curve will have a place where they intersect. And that will be the clearing price. So if we go on this on the notes, you can see what aggregate demand is all about. It's a total demand for all final goods and services in an economy. So it's the sum of all the things that are being demanded by you and me, by companies, by government, by people who come and buy our things. All of us will indicate how much we are demanding of maize or of beans or whatever. And then we have a price, for example, for maize at a national level. And that price is found by finding the intersection between demand and supply. Aggregate supply is the same thing. It's a supply of all goods and services in an economy. So that's an aggregate. We're adding up all the producers, the sum of all producers, industries, companies, individuals, all of us, we add them together. So we'll have the quantity of products that have been produced in a given year. So what you have in this slide, the current slide that is showing, is where we have supply and demand crossing. And where those lines are, those curves are crossing is the clearing price and clearing quantity. So you have the equilibrium price and equilibrium quantity. So now you can see that if we take, for example, maize, we'll have all the suppliers of maize represented by this line called S, and all the consumers or customers of maize are represented by this curve called D. And then we have a clearing price there. Remember, in a perfect market competition market, in a perfect competition market, you have many suppliers and many buyers. So nobody is able to control the price. The price is determined by the market. Now we will see later on that other macroeconomic concepts do develop from this diagram. You remember, we said that when there is excess demand, meaning there's a shortage, prices go up. When demand is more than supply, prices will go up. because there's a shortage. Now, when there's that shortage, which is creating prices to go up in a market, you have a situation where prices are going up. And when prices are rising over a period of time, we call that inflation. And that's why issues of inflation are studied under macroeconomics, because they are aggregate concerns. Now, the concept of total production, these suppliers whom we call producers will give us what we call total production. Just excuse me for a minute. Hello? Hi. Yes. Okay. Yeah, so the aggregate supply, this one, aggregate supply. Aggregate supply is basically aggregate production. Now, this aggregate production usually is given a name. So aggregate supply or aggregate production is referred to as gross national product, for example, or sometimes referred to as gross domestic product, meaning what has Malawi produced, for example. So we will have it as gross national product or gross domestic product. What are the differences? Now, gross national product refers to the value of all goods and services produced in an economy by the people of that economy over a period of time. So gross national product refers to what has been produced in total in terms of the factors of production that are available in Malawi. So if Malawi has factors of production owned by Malawians, this could be land, this could be labor, this could be capital, this could be entrepreneurship, because we have these four factors. And those four factors that are owned by Malawians, Malawian-owned factors of production, those are the ones which have been employed in producing something. That something will be called gross national product. We will not count labor, which is not Malawian. We will not count capital, which is not Malawian. We will not count entrepreneurship or companies which are not Malawians. So this refers to Malawian factors of production. That will give us gross national product. For resources which are not of Malawi, we will not include them in gross national product. In contrast, gross domestic product refers to all products that have produced in Malawi, regardless of who is producing them. So we don't care whether it's an expatriate, whether that labor is not a Malawian labor. We don't care whether that company is not a Malawian company. And we don't care whether the monies, the capital, are not Malawi, are not owned by Malawians. So that is gross domestic product. So basically, Gross domestic product refers to all the output that has been produced in our country within the borders of Malawi, regardless of who owns those factors of production. Gross national product, on the other hand, will take GDP, gross domestic product, and reduce it by any income that has been earned by non-Malawians. So all the expatriate incomes, we must remove them from gross domestic product. All the companies that are earning income, for example, profit, we must reduce that from GDP, and so on and so forth. That the answer will be gross national product. And then I think I should add, what I've explained is not adequate. You should, after you reduce all those earnings by non-Malawian factors of production, we should add all the earnings of Malawian factors of production which are based outside Malawi. So we remove from gross domestic product all the earnings from resources which are not Malawian, but add all the earnings from Malawians or Malawian factors of production abroad. Is this clear? Before I move on, I need to get an assurance that the explanation is understood. Anybody with any comment? Come on, it's your right to ask questions. This is your class. Where it is not clear, I am available to explain. I want you to be 100% clear what I'm talking about. So please, if the explanation is not clear, let me go over it again.
It's clear, sir.
Okay, you deserve it. You deserve to have a full understanding of what I'm talking about. So, for example, we have gross domestic product, which is the production of all the things that have been produced in Malawi. We don't care who has produced them. Fine. Now, we must subtract any earnings which have been accrued to foreign-owned factors of production. So what do I mean? Factors of production are 4: land, labor, capital, and enterprise. Now, as an example, we know that labor earns wages and salaries. Land earns rent. Capital earns interest rates. Enterprise earns profits. So these are factors of production. So for example, if Standard Bank makes profit here in Malawi, Standard Bank is not a Malawian company. That profit goes to the entrepreneurship skills of Standard Bank. So what they earn is profit. That profit should be removed from GDP of Malawi. But we should remember that we may have a company which is a Malawian company, but it has earned profit in a subsidiary which is somewhere else. So for example, First Capital Bank has a branch in Botswana. So if it is making profits in Botswana, we should add that profit to our figures. And the resultant will be gross national product. So we have taken care of all the factors of production. So in this case, we are looking at enterprise as a factor. Nico has got offices, has got branches in Tanzania, in Uganda. Whatever profit there is a reward for entrepreneurship. So that profit should be added to Malawi figures. And all companies that are operating here in Malawi, but they are not Malawians, we should remove their profits from our figures. And the resultant will be GNP, gross national product. I hope the example is clear enough. Now, when you go and read these notes, they are already shared to you in the folder called managerial notes, managerial economics notes. I think these are notes number 4. It should be clear enough. What I've explained is what you see there. About GNP. And then GDP, as I've said, is a market, it's a value of all finished products. Value of all finished products, meaning that, for example, if we were talking about maize, we will not be adding bags of maize. We will be saying how much are these bags of maize that Malawi has produced in a year. So there is a market value, there is a price involved. So we put a price because it's a market value. This GDP we don't count bags of cement to calculate what the GDP of Malawi is. We calculate the value. Okay? And as you can see, this gives us a problem later on, but which I will talk about later. At the moment, this GDP represents how much has Malawi produced. So we can say Malawi last year produced this much, this year it has been producing this much. Or over 10 years, we can see each year what Malawi has been producing. And when there has been a growth in production, in the value of these products, we will be saying there is economic growth. There is growing production. There is economic growth. And you have been, I'm sure, reading or hearing about this term economic growth. Basically, it is coming from the figures that we get from GDP. So if Malawi is growing, it means GDP has been growing. Now, there is a caveat. Is it because we're talking about value? Is it that this GDP is growing because of inflation? Or is it growing because we are producing more bags of maize? Or we are producing the same bags of maize, but because the prices have changed, the market value seems to be higher? Those are some of the issues that when you are looking at GDP over a period of time, you should ask yourself whether does this really show that Malawi is progressing? And we use GDP also to compare between countries. What is the GDP of Zambia? What is the GDP of Tanzania? How has been GDP of Rwanda growing, of Kenya? And for us to do that, we also need conversion rates. So for example, we have to make sure that we are comparing the same things. So Malawi kwacha is not Tanzanian shillings. So we have to make sure that we convert our GDP into US dollars. Tanzania also converts its GDP into US dollars. Then we can see. So it gives us historical performance of an economy, but we can also compare with another country, for example. Now, one important aspect of this is the issue of that GDP is a value, market value of final products. We don't want to count things twice. So for example, if we are looking at how much bread has Malawi produced, we cannot at the same time be saying how much wheat has Malawi produced, how much wheat flour or bread flour has Malawi produced. Because if we start doing this, we'll end up, by the time we count the quantities of bread, the value of bread that Malawi has produced in a year, we will have already counted the value of wheat in it, the value of all the bread flour in it. So we cannot at the same time talking about bread flour, counting it as an item on its own. So anything that is used for producing another product cannot be counted. We are only counting the final products. So intermediate goods cannot be counted. We will leave that out. We are only interested in final products. Now, if you wanted that you count productions of various items as they exist, then you can use an approach which is called value addition. So you say, okay, from wheat is made from, let's say, land. You just plant, and then you have bags of wheat. So from 0 to bags of wheat, you have your answer, and then you say, this wheat has been converted into how many bags of flour, and what is the difference between the value of flour and the value of the wheat? So you only take the difference, add it to the wheat, and then you say, okay, flour has been made into bread. What is the difference between this flour and the bread? The amount of all this flour and the amount of bread, you subtract. So you only be adding the added value additions. So you have the addition in terms of seed, from seed to wheat, and then from what has been added to make it flour, and then what has been added to flour to make the bread. That's what we call value added way of counting. So either you go for the final product, which is bread, forget about the rest, forget about the wheat, or you do value addition. The answer should give you the same. The answer should be the same at the end of the day. Our remaining time is 3 minutes. So if we get cut, don't go away. I'll just, because we're using trial Zoom, which gives us 40 minutes each time. The fortunate part is that we can log in as many times as we want. So once we run out of time, I'll log in again, and then we continue. Now, what are the uses of national or GDP or national income accounting? Basically, these are accounting issues. We are adding up all the production in the country. So basically, we are accountants, okay? But economists. So the economists do the national income accounting, not accountants. So basically, we are adding up a number of these things to get GDP. So GDP is adding up everything that a country produces, from Singano to Ndazi to socks, whatever, everything. We count everything. Anything you can even imagine. Maybe can toothpick, whatever you can button. Any item, we add all those things up to find how much has Malawi produced. And we can see whether we are making progress. Are we producing more from one year to the other? or are we going down, and so on and so on. So this national income accounting is basically bookkeeping that economists do to find economic performance of a country. So basically it's measuring economic activity, measuring economic performance of a country. Just as businesses are also measured in the same way, you find out what the profit is and blah, blah, blah. Countries are also doing the same. So I'll log in again. We're running out of time. I'll log in again. So we can continue.